Let's now revise quickly Accounting Standard 12, Government Grants. This is Chapter 9, Unit 1 of our syllabus. When we talk about government grant, what do we mean when we say government? Government includes state government, central government agencies, local, national, or international bodies also. If any trust gives you grant, if any society or club or a company gives any other person a grant, no, that is not covered under AS12. To be calling it a government grant, it should come from government. What do we mean by grant? Grant basically refers to any assistance or any cash or kind which is given by the government to help that entity reach better heights, because the government believes that this company is doing a very good job. They're working for economical upliftment or fighting against the social evil, creating employment opportunity, having a positive impact on the economy, decreasing the country's dependency on the foreign countries, or any of this. If the government believes so, then they will give them this assistance or anything. So the scope of this standard is it includes grants or assistance. Both are meaning the same from the government entities, which can be both of capital or revenue in nature. Capital in nature means the grant which is received from the government, the economic benefit is derived from the company of that grant for a period longer than a year. It is called revenue grant when the company takes the benefit of it within the same accounting period, within a short term of period. If it is the benefit of the grant received is short term, it is revenue grant. If the government is going to give the grant to you and you are going to take benefit of it for a period longer than the year, beyond a year, then it will be called as capital grant. And this will specifically exclude trading with government. If in case you sell the goods to government, government gives you money, or tax holiday, which we'll discuss under AS22, or if there is any tax exemption in the form of income tax, GST, if it's given, or government contributes to the company as a shareholder, all of these are not considered as government grant. Government grant will include assistance in cash or in kind. For the compliance, government doesn't give the grant straight away just like that. Government would require you to comply with certain conditions. That conditions might have been fulfilled in the past, or government might ask you to fulfill those conditions in the future. Certain times when you open the industry in backward area, they give land free to you. All of that past consideration. When you open hospital, if they give you grant, that is because of past compliance. Certain times in manufacturing entities, they will tell we will give you grant provided you manufacture these many units, you create these many jobs, you import these many you export these much of units. So they'll tell all of these kind of conditions. Those conditions can be future based conditions, and this will exclude anything which cannot be reasonably valued or anything which cannot be distinguished from the normal trading. To be calling an item as grant, you should be able to find its value separately, and you should be able to distinguish from normal trading, meaning like buying and selling with government. Because lot of manufacturing entities, the units that they manufacture is bought by government. Just because government buys it, it can't become government grant. For the purpose of our understanding, we will come back, we'll discuss the accounting grant into two categories. One, first approach is called as the capital approach. Second one is called as the income approach. Capital approach, whatever grant is received will be taken to balance sheet kept under reserves and surplus. Under income approach, that grant what is received will be taken to P&L account. That P&L account might be 1 year P&L, sometimes more than 1 year P&L account also, if the grant is relating to more than one accounting period. This grant which is recognized, it should be recognized only on fulfillment of two conditions. Number one, reasonable assurance. Number two, ultimate receipt. Only when you believe that you have fulfilled the conditions laid down by the government, or you have full belief that you will fulfill the conditions, and you have reasonable guarantee that the government will give you money against this. There is ultimate receipt of money. Only after fulfillment of both of these conditions you have to recognize the receipt. I repeat, number one, there should be reasonable assurance that you will be fulfilling the conditions. Second one, there should be belief that you will eventually collect this money from the government. Only on fulfillment of both of these conditions we will recognize the government grant in our books of accounts. Talking about types of government grant, we can categorize the grant into two categories. One, non-monetary grant. Two, monetary grant. What is non-monetary? What is monetary? Non-monetary is government giving you land free or any asset free of cost, or giving you any asset at concessional price. That is example of non-monetary grant. What is monetary grant? Government will tell, I cannot give you the asset free. You buy the asset, I will reimburse the cost that you paid for the asset. Sometimes full, sometimes partly. If the government says you don't have to pay electricity bill, I will pay electricity bill on your behalf to electricity department. That is non-monetary grant. If the government says you pay electricity bill, show me the bill, I will pay the money back to you. That is monetary grant. So if the grant is received in cash, then it is monetary. If it is not received in cash, it is non-monetary. In short, example for non-monetary grant is only one, asset received free of cost. Two, asset received at concessional cost. Monetary grant is it is cost reimbursed by the government against a specific asset, revenue expense reimbursed by the government, or promoter's contribution made by the government. When we talk about accounting, if it is a non-monetary grant, that is asset received at concessional price, record such asset at concessional price. Let's say the cost of the asset is 1 crore. Government has given the land to you at 10 lakh rupees. Record that land what you received at 10 lakh, the price that you paid. That is concessional price. Next point that we have is what if the asset is received free of cost? If in case you receive the asset free of cost, then there is no money paid. If you are trying to write journal entry, you don't know what value to write the journal entry at. Can you skip the journal entry? No. Because if in case you skip the journal entry, asset will not show up in the balance sheet. So to show such asset in the balance sheet, you record the asset at nominal value. You'll record the asset at nominal value. I'll repeat, when the asset is received free of cost, you debit the asset account at nominal value. Credit will be given to which account? You cannot credit cash because you did not pay cash. So you will be crediting an account depending upon the fact whether the asset is depreciable asset or non-depreciable asset. If the asset that we got is a depreciable asset, credit provision for depreciation account. If the asset that you got is a non-depreciable asset, then you will not credit provision for depreciation. Instead, you will credit government grant account. You will credit which account? Government grant account. This government grant, like capital reserve, will appear in reserves and surplus. It will be staying there only till the time the asset is there. You got that? If the asset is received at a received concessional price, record the asset at concessional price. If the asset is received at free of cost, then record the asset at what value? Nominal value. And credit will be given to provision for depreciation if it is a depreciable asset. If it is a non-depreciable asset, we will not credit provision for depreciation. We will credit government grant. I hope everyone got this. The next point to notice, once you record asset at nominal value, there will be no further depreciation charged. You can never charge any other depreciation against that asset. If the grant received is monetary grant, like you purchase the asset by paying full 1 crore rupees from somebody, government told take 20 lakhs government grant. When the government gives grants that way, so the entity has two options. Option number one, reduced cost approach. Option number two, deferred income approach. What is reduced cost approach? Under reduced cost approach, let's say you bought the asset for 1 crore, government reimburses 20 lakhs. You have first recorded the asset at 1 crore. Asset account debit to bank 1 crore, 1 crore. When the government grant is received, you reduce the 20 lakh rupees of government grant received from the cost of the asset, bringing down the cost to 80 lakhs, and further depreciation from now will be charged, keeping 80 lakh as the base and not 1 crore. This is reduced cost approach. The alternative approach is also available, that is called as deferred income approach. What do you do under deferred income approach? Under deferred income approach, if I keep the same example, an asset is purchased for rupees 1 crore, government is giving me 20 lakh as government grant. 20 lakh government grant, what the government gives me, I am not going to reduce it from the cost of the asset. Instead of reducing it from the asset side, I'll keep it on the liability side under reserves and surplus as DGG, deferred government grant 20 lakh. This DGG 20 lakh what I've kept will be amortized to P&L account over the remaining useful life of the asset in the pattern of depreciation. I repeat, first approach is where you reduce the cost of 20 lakh from the asset value of 1 crore. Asset will be valued at 80 lakh and depreciated over the remaining useful life. That is reduced cost approach. Under deferred income approach, 20 lakh government grant received will be reduced from the cost of the asset 1 crore, making the cost of the asset, asset value will be at 1 crore. 20 lakh rupees grant received will be kept it in DGG, deferred government grant account. As and when you depreciate this 1 crore, let's say over 10 years with zero scrap value, or 10 lakh every year, this 20 lakh will also be transferred to P&L account over 10 years. That is in the same pattern, 2 lakh each year. This is deferred income approach. Which one is correct? Both of them are absolutely same. It is the choice of the entity. Remember that deferred income approach should be transferred. Under deferred income approach, grant should be transferred to P&L over the remaining useful life in the ratio of depreciation. Going to non-depreciable asset. If in case you have a non-depreciable asset, you purchased some land and government gave the money back to you, then what do? Very, very simple. If the conditions has been already met, then that grant received will be returned to capital reserve. Why? You cannot reduce the cost of the asset in that case. If in case the conditions are not met, keep that money and then, if conditions are already met, you will do that. If the conditions are to be met in the future, then based on the fulfillment of conditions, you will go on recognizing that grant amount to P&L account over the period during which you will fulfill the conditions. If the conditions have been already fulfilled, entire grant received will be recorded to capital reserve. It will remain there. That capital reserve is not eligible for declaration of dividend, not eligible for bonus issue, not eligible for anything. It will stay there. It is for a specific purpose. And if the conditions are to be met in the future, as and when you fulfill the condition, that grant will be recognized to P&L. Got that? If it is against revenue expense, two options. Either reduce it from the expense or take that grant straight away to P&L account credit side as income. Last one, what if the government grant is received from the government as promoter's contribution? Meaning at the time of beginning of the business, a percentage of capital is given by the government. Percentage of project capital or percentage of budget, percentage of capital outlay. This is the language that they'll use. Such amount received should be returned to capital reserve. It will stay there only forever till the time the business is there. It will stay in capital reserve. I hope you understood. This is for receipt of government grant. For some reason, if in case you have failed to comply the conditions what you thought you will fulfill, if the government thinks that you are not eligible anymore, government can ask you to pay the grant which they had given back to government. When the government asks you to pay the government grant back, it is called refund of government grant. This refund of government grant is an extraordinary item as per accounting standard 5. You can refer AS5 revision to understand what is extraordinary item and what will be the entry for this refund. Entry for refund depends upon what was the entry that we had written in the past. In the past, if it was reduced from the cost of the asset, now we should add it back to the cost of the asset. In the past, if we had treated it as deferred income, the balance in deferred income will be reversed by paying the government back the money. Let's say we had received 20 lakh of government grant. I had reduced 20 lakh from the cost of the asset 1 crore, making it 80. That 80 is depreciated for 3-4 years. Now it has come to about 55 lakhs. Now the government is asking me to refund entire 20 lakh. Now somewhere my asset is 55. When I had received the grant, I had reduced it from the cost of the asset. Now I add this 20 lakh back to the cost of the asset, increasing it to a new amount. Alternatively, if I had followed deferred income approach, asset value would have been 1 crore. Deferred government grant would be 20 lakh. This little is transferred to P&L. If entire 20 lakh is there in DGG and I'm refunding entire 20, debit deferred government grant, credit bank entire 20 lakh over. What if little part of this deferred government grant is already transferred to PL, because of which only 15 lakh is available in deferred government grant, but I am supposed to refund 20 lakh. What would we do in that case? Deferred government grant should be debited by 15 lakh funds available. Bank account should be credited by 20 lakh. Difference of 5 lakh should be debited to P&L because from deferred government grant that 5 lakh had gone to P&L. Now we're taking it back from P&L and transferring it to refund back to government. Understood? If it was previously against a non-depreciable asset, you would have credited to capital reserve. Now debit capital reserve, credit bank and then pay. Same would be the entry in the case of promoter's contribution also. However, if it was against revenue expense, would have previously reduced the expense, now increase the expense back. Or previously, if you would have booked as expense, I'm going to say that deferred government grant, sorry, this revenue expense grant received was booked as income. Now this refund, you book it as expense. You charge it as additional expense or reverse the income, as the case may be. Whenever you follow any of the approaches, when the choice is given to you, do mention in the accounting as to what is the approach followed by the entity based on the options available and what is the nature and extent to which grant is recognized, what is the nature and extent to which grant is deferred, or why is it not recognized as income? Is it because the conditions have been not fulfilled? All such requirements have to be disclosed. These are disclosure requirements, and that's accounting standard 12.